Hello, hi students. In today's class, we'll go through few more examples on how to determine the performance obligation under Ind AS 115. So kindly go through this illustration 23. And summary of this illustration is that so here there is a contract for sale of product A at rupees 1000 with offer to provide additional discount up to 40%, that is restricted up to rupees 1000 for any future purchase within 30 days. So the product sale value is 1000 rupees and there will be a discount of 40% restricted to 1000 rupees if there is a repeated order within 30 days. So that's a special discount, but there is an existing offer that 10% discount will be given to all sales for next 30 days. That's the usual sales, but apart from this 10%, there will be a 40% another discount also available. Okay, and the entity estimates that 80% chance that customer will avail the 40% discount scheme. So there are two schemes. One, the regular discount of 10%, and second is if the customer comes back and procures within 30 days repeated orders, then there will be the discount rate will be increased from 10% to 40%. So that's how this example is structured. And here the entity estimates that 80% chance that the customer will avail the 40% discount, which means they will come back and then repurchase from the entity up to 500 rupees. So initial purchase is 1000 and repeated order estimated to be 500 rupees. So here we'll have to see how many performance obligations are there. So here there is the performance obligation number 1 will be the regular sales with 10% discount to all the customer. That's a usual business that's being offered as the seasonal arrangement in this period. And second obligation is with special discount, that is the additional 30% discount. So out of 40%, 10% kind of usual one, and an additional 30% discount will be given in case if repeat orders are given by the customers. Okay, so here providing the discount would be a separate performance obligation, so that should be noted down. Okay, so now we'll see how the transaction price or the standalone transaction price can be determined. So assume the base price is 1000 rupees and 30% additional discount on 500 rupees. So because the entity estimates only 500 worth of order will be repeated using this special discount scheme. So 30% on 500 would come to 150. But the chance to get this repeat order is only 80%. So 80% of 150 comes to 120. So the total standalone price would be 1120. I mean standalone price without discount is 1120. Okay, now let's see how to allocate the transaction price of product A towards contract of sale of rupees 1000. Okay, so here the total contract of sale is 1000, but this 1000 assuming it includes discount. So in case of discount, then the standalone price is 1120 for the net sale price of 1000. So if you do the prorated working, the base value for 1000 would come to 890 and the discount value will come to 110. Okay, so this is how the two performance obligation transaction price is allocated. So for the obligation number 1, which is sale of the product, the transaction price is 890, and for obligation 2, which is providing discount, the allocated transaction price is 110. Okay, and let's go through the next example. So please go through illustration 24. So in this illustration, there is a contract to provide cable services at rupees 800 per month for 3 years. Okay, and service of providing the cable connectivity is rendered on a daily basis. Okay, so here we have to determine how many performance obligations are there in this company. Okay, here there is a continuous service being provided. I mean, providing the cable services is kind of continuous service, and the same kind of service, there is no new services being offered. So same kind of services is being given over 3 years. So with this we can conclude that it is a single performance obligation, because the same kind of service is provided over the period of 3 years. So clubbed together, it's a one single performance obligation. So providing cable service for 3 years at ₹300 per month is a single performance obligation. So revenue will be recognized over the period of 3 years, meaning the day or month passes and service is completed, then during that month the revenue will be recognized on a prorated basis. Okay, so please go through illustration 25. So in this illustration, M enters into a consignment contract with a retailer A for 1000 dresses, and A will pay to M at the rate of ₹20 per dress when sold to the end customer, and in case of any unsold inventory will be returned back to M, or M can also redirect to any other consignee. Okay, so in this case, since retailer A does not carry any inventory risk, the control of inventory is transferred from M to A when A sells to the end customer. So the control of the inventory is transferred from M to A when A sells to the end customer. Okay, then please read the next illustration 26. So here there is a contract between an entity and the airline for the sale of air tickets. Okay, the price at which the entity buys from the airline is pre-agreed, and the entity buys bulk quantity of ticket and will pay even if the tickets are unsold to the customer. So the entity buys the bulk quantity from the agency, and they will pay for the entire bulk quantity, and even if the entity could not sell the tickets to the end customer, still they have the obligation to pay to the airline. Okay, so the price to the end customer is fixed by the entity. So the price to the customer is fixed by the entity and collected when sold. Okay, and the entity is responsible for any claims. Our airline is responsible for fulfilling the obligation associated with the ticket. Okay, so now we'll have to determine whether the entity is a principal or agent. Here the entity has primary responsibility of selling the air ticket, which provides a right to end customer to fly. So the entity carry inventory risk because they buy the ticket upfront and sell to the end customer. In case of unsold tickets, then that's the risk to the entity. The entity has the right to fix the price with the end customer. Okay, so the entity carries two significant business risks here: the inventory risk and fixing the price. So considering the above, the entity will be considered as principal and not agent. So there is no credit risk. That doesn't matter, because that's usual in the industry to get paid when the tickets are sold to the end customer. So no credit risk will not impact the decision that the entity is principal and not the agent. Okay, so please go through the next illustration 27. So here the summary of the question is: there is a contract between F Limited, which is a type of media company, and D Limited, which provides advertising services to its customers. And D Limited is responsible to make films as per the customer needs. And D Limited decides on which advertisement to be placed when. So the slots being decided by D Limited. There is no inventory risk to D Limited, as there is no minimum slot purchase requirement from F Limited. So the price of airing the advertisement is fixed between F Limited with the end customer. So here we'll have to determine whether T is a principal or agent. So in this case, D Limited has primary responsibility. So the primary responsibility includes designing and airing the advertisements. So designing and airing is a key business risk that's being performed by D Limited. So because D Limited have the significant risk, we can conclude D Limited is a principal and not agent. So the fact that the D Limited does not carry inventory risk. So in the previous example, we saw that the entity carried inventory risk, but they have not carried credit risk. But still we have concluded that entity is a principal. So here there is no inventory risk, but D Limited carries other kind of risk like designing and airing the slots. So they have those other business risks. So we'll have to just assess whether the entity carries any kind of key business risks. If so, then we can conclude that entity as a principal. But if the entity does not carry any business risk, any kind of business risk, then the entity may be considered as an agent. Okay. Then we'll go through next illustration 28. So here the summary of question is, there is a contract to provide data connection services, and the consideration includes one-time charges for activation and regular fee based on usage. So here the activation and data usage are inseparable. Okay, so because without activation, data provision service cannot happen, and to have just have the activation without data provision service also will be meaningless. That's why both are inseparable. So we can conclude that providing activation and data usage service are one single performance obligation. So this is the exam question. So please take time to read this question. So here the summary of the question is, so there is a contract between XYZ Limited, a marketing company, with 4 amusement parks. And contract term is to buy the tickets upfront at a discounted price and sell to general public through online mode at a price fixed by XYZ Limited and not by the amusement park. So here also there is no credit risk, because as per the industry practice, the cash will be collected at the time of sale of the tickets to the end customer. And XYZ is responsible to arrange for the park services to end customer. However, the amusement park is responsible for providing the entertainment services. Okay, so here we can conclude XYZ, since they have some key primary responsibility of selling their ticket, which provides a right to end customer to avail the entertainment services. They also carry the inventory risk, and they also have the right to determine the price to end customer. So considering all the above, we can conclude XYZ Limited is a principal and not agent. So here also there is no credit risk, so that doesn't matter. So they can still be the principal as they can carry other key business risks. Okay, so now we will move to step 3 of Ind AS 115, which is determining the transaction price. Okay, so please go through illustration 29. So here summary of the question is, there is a contract between XYZ and customer to build a special machinery for a price of 2.5 crores and to be delivered before 31st March 2021. In case of any delay, there will be penalty of rupees 1 lakh per day, and in case of yearly delivery, there will be incentive of rupees 1 lakh per day. So that's the variable consideration given in the contract. And over and above the incentive, there could be a bonus of rupees 15 lakhs if quality meets the standard. So now let to determine the transaction price. So the base transaction price is rupees 2.5 crore and the variable consideration towards incentive or penalty to be adjusted based on the best estimate. So as on date, the entity may not know whether the incentive or penalty would be there, but as they progress or as they estimate based on their confidence level, the incentive or penalty should be brought into the transaction price. So here those incentive or penalty will be the variable consideration. And bonus is also kind of variable consideration, and that also needs to be adjusted to the transaction price based on the best estimate. So para 53 of Ind AS 115 allows adjust the transaction price based on the best estimate, but the estimate should be reasonable. It should be backed up with some kind of a past practice or kind of some analysis or some technical experts. Yeah, so a mere estimate may not be sufficient. It should be a best estimate backed up with kind of a technical mode, we would say. Yeah. Okay, so please go through next illustration 30. So here the summary of the question is AST Limited enters into a contract with its customer to build a manufacturing facility. Okay, and the construction duration is 36 months and consideration is 25 crores. And there will be 15% bonus if completed within 30 months, for which only 25% likelihood. Otherwise 10% bonus will be provided if completed within 32 months, for which 40% likelihood is there. And 5% performance bonus is provided if completed within 34 months, for which 15% likelihood. Then 0% bonus, for which 20% likelihood. Okay, so in addition there is a quality bonus of 2 crore if gold star is obtained. If gold star, it's a kind of quality certification, is obtained, for which 60% is likelihood. Okay, so now we'll have to allocate the transaction price. Anyway, so the base transaction price is 25 crore. Then let's see how the bonus to be allocated. So for the 15% bonus, which comes to 3.75 crores, the probability is 25%. So 25% or 3.75 crores can be allocated to the transaction price. Similarly, 10% bonus comes to 2.5 crores, for which 40% probability, that comes to 1 crore. And 5% bonus, that comes to 1.25 crore, for which 15% probability, that comes to 18,75,000. And for 0% probability, which is 0, 20% probability, 0% incentive, for which 20% probability is there, so your net bonus will be 0. So the weighted average of bonus total comes to 2.125 crores. So for bonus, the variable consideration can be either yes or no. So for the bonus, the gold star certification, either gold star certification will be there or will not be there, yes or no. But here the entity estimates 60% likelihood, so they have a good chance. So in that case, we can include bonus also into the variable consideration. Okay, so the total consideration could be your base value of 25 crore and 2.125 crore relating to bonus, and 2 crore relating to 2.125 crore relating to incentive, and 2 crore relating to bonus. So altogether 29.125 crores is the total transaction price. Okay, we'll move to the next example. So please take time to read this illustration 31. So in this illustration, HT Limited enters into a contract with its customer to sell product X for rupees 1000 per unit. And if order quantity is more than 100 units, the price will be reduced to 900 per unit. Okay. So if the order quantity is less than 100, then the price is 1000. If order quantity is more than 100, then the price will be reduced to 900 per unit. And actual quantity for the first quarter is only 10 units. And at the time, the expected volume for the full year will be less than 100 units, which means the price will remain at 1000 and discounted price of 900 is not applicable. However, in Q2, the actual sale was 50 units. And the increase is attributed to some acquisition done by the company. Okay. So with this, the HT Limited revised the full year estimate and concluded that it will cross more than 100 units. So for Q1, it was estimated that 100 units threshold will not be met, but in Q2 it's revised because of some additional business transaction happened. The entity revised its estimate to more than 100 units. Okay, so now let's see how HT Limited should account for this transaction. Okay, so here we need to look at the best estimate made by HT Limited. Okay, for Q1 the revenue will be just 1000 unit into 10,000 rupees, right? Because at that time the discount was not envisaged. So for Q2 they have sold 50 units, and since discount was allowed, so the rate will be 900. So 45,000 rupees will be the total revenue. So even though they have sold only 50 units, the revenue is accounted only at 900 because the entity estimated that it has to give the discount of 100. That's kind of estimate. So it will account for revenue after discount only. And they also need to adjust the additional revenue recognized in Q1. So Q1 the revenue was recognized at 1000, but it should have been recognized at 900. So the excess 100 for 10 units comes to 1000 should be reduced from Q2 revenue. So the net Q2 revenue will be only 44,000. Okay, so the impact due to change in estimate to be adjusted only prospectively and not to be retrospectively adjusted, which means you don't have to go back and reduce or adjust the revenue in Q1, but Q2 you have to account at 9 rupees, and also in Q2 you can adjust the prior period errors. Okay, so let's move on to the next example. It's a big question, so please take some time to read this question. So I have tried to summarize the question here. So here the entity to develop a product for a fixed fee of rupees 10 lakhs, and the estimated cost for the development is 9,50,000, and the expected duration is 5 years. So the fixed fee is 10 lakhs and the estimated cost for the development is 9,50,000 and the duration is 5 years. Okay, and there will be incentive program. So 25% incentive will be provided if the product weight is less than 700 kg, and the incentive will be only 10% if the product weight is less than 950 kg. Okay, and the entity estimates 95% confidence level that 10% incentive will be achieved, and they have only 20% confidence level that 25% incentive will be achieved. Okay, and the estimate up to 3 years was that only 10% incentive will be achieved. But during 4th year they have revised estimate. They had more evidence that the 25% incentive can be achieved. Okay, and they also given the cost pattern. Year 1 they will incur 50,000, year 2 175,000, year 3 400,000, year 4 275,000, and year 5 50,000. This is how the total cost of 950,000 is allocated. Okay, so let's go through the solution. So here the fixed consideration is given as 10 lakh and the estimated cost is 9,50,000. Now let's see how this 10 lakh will be allocated over the period of 5 years. So basically the company will account for revenue based on the percentage of completion method. So as the costs are incurred, so here the cost, how it will be split over 5 years, 9,50,000 split like this. So in year 1 50,000 is spent. Okay, so for 50,000 you can recognize 52,632 as the revenue, right? So the percentage of completion is 50,000 by 9,50,000, that's the percentage of completion. Over 1 million will be 52,632, so that's a revenue recognized in year 1, fixed revenue. Similarly second year it will be 182, so 175,000 divided by 950,000 into 1 million will be 184, and year 3 will be 421,000, which is 400,000 divided by 950,000 into 1 million, and year 4 is 289,474, which comes from 275,000 divided by 950,000 into 1 million, and year 5 is 52,632, that is basically 50,000 divided by 950,000 into 1 million. So that's how the fixed revenue is allocated over 5 years. Then you have a variable revenue. So a variable revenue for year 1, 2 and 3, the estimate is 1 million. So this 1 million needs to be allocated over 5 years. So same formula we can use here. So 50,000 divided by 950,000 into 100,000 will give 5,263 as the variable consideration allocation for year 1. So similarly 175,000 divided by 950,000 into 1 million, that gives 18,421 for year 2. For year 3, 400,000 divided by 950,000 into 100,000 will give 42,105. And year 4 you are revising to 250,000, so your incentive will be 250,000. So here how 250,000 is allocated, so same formula. So 275,000 divided by 950,000 into 250,000 will give 289,000. Okay, and for year 5 also same formula, 50,000 divided by 950,000 into 250,000 will give 52,632. Okay, that is how the variable consideration is allocated. Okay, so I'll repeat. For year 4 the 72,368 comes basically 275,000 divided by 950,000 into 250,000 will give 72,368, and for year 5 50,000 by 950,000 into 250,000 will give 13,158. Okay, that is how the variable consideration is allocated. Okay, and that should be some cumulative revenue adjustment, because this 250,000 should have been recognized in year 1 and 2 and 3, but since those books are already closed, we don't have to go back and correct those years, but we have to make a cumulative adjustment in year 4. So in year 4 what you can do is 50,000 plus 175,000 plus 400,000, that's the total cost incurred, divided by 950,000 into 250,000 minus the revenue already recognized will give 99,370. That's the additional revenue can be recognized. So that gives the total revenue 57,895 year 1, 202,632 year 2, 463,158 year 3, 461,212 year 4, 67,790 year 5. Okay, so in summary this is how it's in total it will look like. So the fixed revenue 10 lakhs will be recognized, and variable revenue 250,000 will be recognized. So the total revenue will be 12,50,000 and total cost is 950,000. That gives margin of 300,000, which is the 24% margin percentage. Okay, we'll move to the next illustration. So please go through illustration 33. So in this illustration, an entity enters into 5-year asset management contract with its customer, and consideration is 2% per quarter, and asset base was 100 crore. And there will be incentive at the rate of 20% if return exceeds specified threshold. So here we have to analyze the revenue to be recognized for 31st March 2022. Okay, so here for the quarter ended March 2022, the revenue will be 2% on 100 crore, that is 2 crore. Okay, so they have given the asset base 100 crore and the quarterly fee is 2%. So that gives 2 crore. That will be the revenue for March 2022. And they have not given anything specific on the incentive. So how much return they have actually achieved, there is no such information. Hence, we are not taking any incentive to be recognized for March 2022. So the only revenue will be 2 crores. Okay. So please go through illustration 34, which is example on rate of return. Okay, so here the summary of question is there is a contract to sell 1000 unit at the rate of 50 and cost to manufacture that product is 30. Okay, and full cash is refunded if there is any quality issue and returned back to the entity within 30 days. So full cash refunded if there are any quality issue and the product is returned back within 30 days. The entity estimate 970 units will not be returned, so meaning 30 units might be returned. So that's the estimate. But what are the return quantity? The entity expects to resell with profit, so there is no inventory loss. Okay, so here the revenue will be 48,500, which is 50 rupees per unit into 970 unit. That's the base revenue can be recognized. And we have to recognize a refund liability because the entity estimates that 30 units will be returned. So which means whatever the amount received for those 30 units, it's not a revenue, but it's a liability. Refund liability needs to be created. So 30 into 50, 1,500 rupees, a refund liability needs to be created. And for those 30 units, you can create kind of asset or the inventory because that's the inventory held on consignment basis. So still it's your paid inventory. So this 900 can be recognized as an asset. Okay, so please read illustration 35. So in this illustration, an entity sells computer with assured warranty for 90 days. Okay, and breakdown is 32,000 for the computer and 4,000 for the 3-year extended warranty services. Okay, and the cost of the computer given as 14,400 and estimated cost of repair for 90 days assured warranty period is 2,000. So let's see what the journal entry to be passed. So here cash is collected for 36,000 rupees, so you can debit cash account. And the estimated warranty expenses for the first 90-day warranty is 2,000 rupees, for which you are also creating the warranty liability, accrued warranty cost. Okay, and only 32,000 you can recognize revenue, and remaining 4,000 it's kind of contract liability because you are receiving this towards the extended warranty, so for which the service not yet rendered, so it's a contract liability. Okay, so that's for revenue and contract liability, first entry. And second entry is for every computer there is a manufacturing cost of 14,400 that should be debited to COGS account and credit to inventory account. Okay, now let's move on to illustration 36. Okay, so here the entity sells 100 units of battery at the rate of rupees 2000 with a 5-year guarantee. Okay, and the entity normally provides 1-year guarantee to its customer. Okay, the entity determines 170,000 of the 200,000 transaction price should be allocated to the batteries and 30,000 to be allocated as the service warranty. So here let's see how the journal entry to be made. So here also we are receiving 200,000 as cash, so cash to be debited, and revenue to be credited only 170,000, and 30,000 which is the allocated price towards warranty, for which you have to create the contract liability. And for warranty expenses you have to make an accrual which is at 10,000 rupees, debit warranty expenses and credit accrued warranty costs. Okay, now let's move on to the next example. So please go through illustration 37. Here the summary of the question is, there is promised consideration for supply of airplane, that is 70 lakhs. And scenario 1, assume price includes 1.4 lakhs towards insignificant financing component as advance is received. And scenario 2 is assuming 14 lakhs towards significant financing component as advance is received. Okay, so in case of insignificant financing component, no adjustment is needed. You can still recognize 70 lakhs as the revenue. So it's insignificant because it constitutes only 2%. Again, judgment needs to be used whether 2% is significant or insignificant. But here in the example they have given this 2% is insignificant, so it does not require any adjustment. But in scenario 2 they have said it is significant because it's 20%, 14 lakhs, then it requires adjustment. So what is adjustment is needed? So here the revenue to be recognized net of the significant financing component. So from 70 lakhs you have to minus 14 lakhs, only 56 lakhs will be recognized as revenue, and remaining 14 lakhs to be recognized as interest income. So here you can also refer Ind AS 109, accounting for financial instrument. So as per Ind AS 109, this 14 lakhs being the significant financing component should be accounted separately as interest income and not as revenue. Okay, so we'll move to the next example. So please read illustration 38. So here the contract includes a significant financing component. So this is evident from the difference between the promised consideration of 1,21,000 and the cash selling price of rupees 1 lakh. So 21,000 clearly it is demonstrated as a significant financing component. So the contract includes an implicit interest rate of 10%. Okay, that gives this 21,000 rupees. The entity evaluates the rate and concludes that it is commensurate with the rate that would be reflected in a separate financing transaction between the entity and the customer at contract inception. So 100,000 is your base price, and if you sell at cash price you will get 100,000, and you are just providing a kind of extended credit to them, and you are charging interest at the rate of 10%, for which you are recovering additional 21,000 rupees. So it's clearly this 21,000 rupees is a consideration towards interest compensation and not for your base business revenue. So until the entity receives the cash payment from the customer, interest revenue would be recognized in accordance with Ind AS 109. Okay, interest income for 21,000 rupees would be recognized under Ind AS 109. Okay, we'll move on to the next example. So here VT Limited enters into a contract with the customer to sell an equipment. So control of the equipment transfers to the customer when the contract is signed. The price stated in the contract is 1 crore plus 10% contractual rate of the interest payable in 60 monthly installments of rupees 212,470. So now we have to determine the discounting rate and the transaction price when contractual discount rate reflects the rate in a separate financing transaction. So the contractual discount rate reflects the rate in a separate financing transaction, and case B is contractual discount rate does not reflect the rate in a separate financing transaction, that is 14%. So for case A, where the contractual discount rate reflects the rate in a separate financing transaction, so in evaluating the discount rate in the contract that contains a significant financing component, BT Limited observes that 10% contract rate of interest reflects the rate that would be used in a separate financing transaction between the entity and the customer at contract inception. Okay. The market terms of the financing means that the cash selling price of the equipment is 1 crore. This amount is recognized as revenue and as loan receivable when control of the equipment transfers to the customer. The entity accounts for the receivable in accordance with Ind AS 109. Okay. Then case B, contractual discount rate does not reflect the rate in a separate financing transaction. So here, to evaluate the discount rate in the contract that contains significant financing component, the entity observes that 10% contractual rate of interest is significantly lower than 14% interest rate that would be used in a separate financing transaction between the entity and its customer at the contract inception. Okay. So here VT Limited determines that the transaction price by adjusting the promised amount of consideration to reflect the contractual payment using 14% interest rate that reflects the credit characteristics of the customer. So consequently, the entity determines that the transaction price is 91,31,346, that is 60 monthly installments of 212,470 discounted at 14%. So you can work out the discount rate at the rate of 14%, then you will have this 91,31,346. So here the entity recognizes revenue and a loan receivable for this amount. So the entity accounts for the loan receivable in accordance with Ind AS 109. Okay, then let's go through the next example. So here ST Limited enters into contract with the customer to sell an asset. So control of the asset will transfer to the customer in 2 years. That is, the performance obligation will be satisfied at a point in time. That is, once the handing over is happened, after 2 years, then the control is transferred. The contract includes 2 alternative payment method. One, payment of rupees 5,000 in 2 years when the customer obtains the control of the asset, or pay 4,000 upfront when the contract is signed. The customer elects to pay 4,000 when the contract is signed. So here the customer elects to pay 4,000 when the contract is signed. Okay, so ST Limited concludes that the contract contains a significant financing component because of the length of the time between when the customer pays for the asset and when the entity transfers the asset to the customer, as well as the prevailing interest rate in the market. Okay, the interest rate implicit in the transaction is 11.8%, which is the interest rate necessary to make the 2 alternative payment options economically equivalent. Okay, so 11.8% is the interest rate implicit to ensure the 2 alternate payment term economically equivalent. However, the entity determines that the rate should be used in adjusting the promised consideration is 6%, which is the entity's incremental borrowing rate. So let's pause the journal entry. So first the entity goes for 4,000 rupees option. So there is a cash receipt of 4,000 and a contract liability is created at the time of receipt for 4,000 rupees. Then the incremental borrowing rate is 6% for 2 years, that comes to 494. So for 494 also you have to create the contract liability by debiting the interest expense. Okay, then at the end you can recognize the revenue and transfer the contract liability to debit. Okay, then let's go through the next example. So here ABC Limited concludes that the contract does not include a significant financing component since a milestone payment coincide with the performance and the contract requires the amount to be retained for reasons other than the provision of finance. So the withholding of the specified percentage of each milestone payment is intended to protect the customer from the contractor failing to adequately complete the obligation under the contract. So this is nothing to do with the financing component. Okay, so let's go through the next example. So here XYZ Limited, a personal computer manufacturer, enters into a contract with the customer to provide global PC support and repair coverage for 3 years along with its PC. The customer purchases the support services at the time of buying the product. So at the time of buying the product itself, the service is offered. So consideration for the service is an additional 3,000 rupees, and customers electing to buy the service must pay for it upfront. That is, a monthly payment option is not available. So analyze whether there is any significant financing component in this contract. Okay, so here all these arrangements were structured primarily for reasons other than provision of some financing component. Right, so we can conclude here there is no significant financing component in this example. So all these are for reasons other than financing. It's kind of a business requirement is there for the other models. Okay, so let's go through illustration 43. Here also, due to customer's credit rating, the customer pays in advance for the 3-year term because there is no difference between the amount of promised consideration and the cash selling price. So the vendor requires payment in advance only to protect against customer non-payment and no other factors exist. Okay, no other factors exist. One, it's all kind of business related payment terms. Okay, so hence there is no significant financing component in this example. Okay, so please go through illustration 44. So here, although the payment will be made in arrear, because the total consideration varies based on the occurrence or non-occurrence of a future event that is not within the control of the customer or the entity, the software vendor conclude the contract does not provide a customer or the entity with a significant benefit of financing. So here also there is no significant financing component. Okay, so please go through illustration 45. So here there is no difference between the amount of promised consideration and the selling price, cash selling price, and hence here also there is no significant financing component. Okay, so please go through illustration 46. So here company Z enters into contract with company X to supply 5,000 special missiles, and consideration is cost plus award fee of 100 crores, and payment term is cost will be reimbursed as the company incurs, and award fee of 100 crore is paid at the end of the contract, and by when a quality certification or quality assessment will also be made. But it expects to receive only 80 crore as the award fee, because it expects some kind of the quality issues are not up to the mark, so only 80% confidence level they have to get the award fee. So here also there is no significant financing component, as the award fee is linked to other business reasons and not with respect to financing component. Okay, so please go through illustration 47. So here company H enters into a 2-year contract to develop customized software for company C. So customized software is getting developed for customer C, and company H concludes that the goods and services in this contract constitute a single performance obligation. Okay, and based on the terms of the contract, company H determines that it transfers the control over time and recognize the revenue based on input method. Okay, and company C agrees to provide company H monthly progress payment. So based on the expectation of the timing of the cost to be incurred, and company H concludes that progress payment are being made such that the timing between the transfer of control and the payment is never expected to exceed more than 1 year. So here let's analyze any significant financing components are there. So here also we can conclude there is no significant financing component, as the payment term is linked with the milestone. So as the company makes the progress, then the company gets paid. So there is no advance or there is no arrear in payment where the financing component might be involved. Okay, so there is no significant financing component in this example. Okay, so please go through illustration 48, entitlement to non-cash consideration. So here the entity measures its progress towards complete satisfaction of the performance obligation as each week of service is complete. So to determine the transaction price, the entity has to measure the fair value of 100 shares that are received upon completion of each weekly services. The entity shall not reflect any subsequent changes in the fair value of the shares received. So whatever the fair value at the time of completion of services will be recognized as revenue, and no changes to be made to the value of shares subsequently. Okay, so go through illustration 49. Here also the ultimate value of any shares of the entity might receive could change for two reasons. The entity earns or does not earn the share, that could be one reason, and the fair value per share may change during the contract term. Okay, so when determining the transaction price, the entity would reflect the change in the number of shares alone. However, the entity would not reflect the change in the fair value per share. So said another way, the share price of ₹100 is used to value the potential bonus throughout the life of the contract. As a result, if the entity earns a bonus, its revenue would be 350 crore plus 10 lakh equity shares of ₹100 per share. Thus the total consideration will be 360 crores. Okay, so let's go through illustration 50. So here Y determines the transaction price is rupees 1600, comprising of 1000 fixed amount plus fair value of the advertising slot at rupees 600. So in the fair value of the advertising slots could not be reasonably estimated, then the transaction price would be 1500. That is why would use the standalone selling price of the goods or services promised for non-cash consideration. Okay, so let's go through illustration 51. So here, as a result, at contract inception, SK Limited includes the fair value of the tooling in the transaction price at contract inception, which is determined to be 27 crore. So 25 crore for steering system and 2 crore for the tooling system. So let's go through illustration 52. So here then an entity that manufacture consumer goods enters into a 1-year contract to sell goods to a customer, that is large global chain of retail stores. The customer commits to buy at least 15 crore of product during the year. Okay. The contract also requires the entity to make a non-refundable payment of rupees 1.5 crore to the customer at the inception of the contract. The 1.5 crore payment will compensate the customer for the changes if it needs to make to its shelving to accommodate the entity's products. The entity does not obtain control of any rights to the customer's shelves. So here let's determine the transaction price. So here let's apply paragraph 72 of Ind AS 115 and concludes that consideration payable is accounted for as a reduction in the transaction price when the entity recognizes revenue for the transfer of goods. Consequently, the entity transfers the goods to the customer. The entity reduces the transaction price for each goods by 10%. Okay, therefore, in the first month in which the entity transfers the goods to the customer, the entity recognizes revenue of 1.125 crore only. Okay, so let's go through illustration 53. So here D Limited determines that it should account for the port in credit as consideration payable to a customer. This is because the credit will be applied against the amount owing to D Limited. Since D Limited does not receive any discount goods or services in exchange for this credit, it will account for it as a reduction in the transaction price, that is 17,200. So D Limited will recognize the reduction in the transaction price as the promised goods or services are transferred. Okay, thank you. Let's catch up in the next call.